Hi everyone. Hopefully you can all hear me and see this screen here with my presentation. I know last time out didn't go so well at the beginning, but hopefully this time will be much better. But anyway, yeah, so we're going to talk about, or I'm going to talk about the perils of overtrading and over leverage today. What I'm going to do first is show you the disclaimer. Basically, because I'm going to be talking about live market information once I've got through my first bit of spiel, and that means that you need to have read and understood the disclaimer and all its intricacies. So that's that. And what I'll do is I'll put the disclaimer back up at the end, just in case you haven't had a chance to read it first time out. But there it is. A little bit about me as usual. I mean, doesn't ever change. Been working in London for 14 years for a variety of forex brokers and equity brokers as well. Now talking about now at Hantech, looking predominantly at forex and also CFDs, which are sort of markets such as DAX, FTSE, S&P, and also bullion, which is gold as well. So they are my specialities I talk about on a regular basis, and I talk about on CNBC, quoted on Reuters and Market Watch as well. Right. Right. Before I get into it, I'm going to try and be very as quick as possible, actually, because I've got a lot to get through. But we're going to just talk about, first of all, a little bit about overtrading, what actually overtrading is and what the warning signs are that you are overtrading, because it can be a very dangerous aspect of your trading, and also over leverage as well, because over leverage and overtrading, I believe, are sort of two sides of the same coin, really, and two things that aren't specifically the same thing. However, they are very dangerous aspects that if you find them creeping into your trading, you can get yourself blown up fairly quickly, which I think is a potential problem for retail clients. So these are two things that you need to be aware of and try and get a handle on. I'm going to talk about the impact of overtrading and also what you can do to prevent them from affecting your trading. After that, I'm going to talk about live market analysis. And through that, you can, or throughout, to be honest, you can ask me questions via the chat box or question box, and I've got them both open, so hopefully I'll see them. But if you do sort of ask me a question, I don't get around to answering it, then please just try it again at the end, or once I've gone through the sort of basic overtrading, over leverage bit, because obviously I'm going to then be talking about live market stuff, and then you can sort of ask me whatever you like, really. So we'll focus on that. But for now, I'm going to talk about a bit of theory stuff, and that's overtrading and over leverage. Right. Now, what is overtrading? Starting off with overtrading, there are several aspects to overtrading. Now, for example, if your trading ideas don't conform to your predefined trading strategy, then that can be a big sign that you're overtrading. And I suppose in a way, sort of forgetting how many trades that you're putting on would suggest that you're becoming detached from your trading. I mean, for example, having too many trades open at once can be a sign that you're overtrading, and also trading before you've put in the required analysis and research, again, can be a sign of overtrading. So what I'm going to do is I'm going to look at the specific things in detail, the specific aspects of overtrading in detail, and if you do see them cropping up into your trading, then you need to try and get a handle on them and try and do something about it, because they have a big impact negatively on your trading potentially. Right, the traits to be aware of. There are six traits I've got here, so I'm going to try and rattle them through them fairly quickly. First of all, having too many trades open, as I just said just now, it certainly can be a sign of overtrading. It doesn't necessarily have to be, though, because maybe your strategy is to be, say, for example, a scalper, where you're doing maybe 20 or 30 trades a day. And that's fine. But what the main thing you need to understand is that your risk per trade is adjusted accordingly. Say, for example, you've got, you're trading and you trade sort of 4, 5, or 6, maybe 4, 5 or 6 times a day, and you're using the same risk per trade as someone who's trading just once or twice a day, then you are certainly taking on a much greater risk, and potentially then you are over trading. It sort of all basically comes down to how much of your account that you're going to risk in the market, perhaps across the course of a day. I've said previously that if you sort of trade and your risk per trade is into double figures, then I'm of the opinion that that's becoming a bit excessive. However, I also believe that it's the case. It can be the case that it's the same with someone that who may not have an enormous appetite for risk, sticks to a low risk per trade, but through the accumulation of lots of different trades, you actually find yourself taking on a much greater exposure to the market across the course of one day. So I suppose in that regard, there's a little bit of a hazy difference between overtrading and overleverage, but I think taking on too many trades can be a big risk and can be a sign of overtrading. Number 2, trading before you've put the required analysis in. Effectively, I suppose it's trading before you've got confirmation of your trading setups. And to coin a phrase, I suppose it's jumping in too soon. I've got a mantra when I do analysis, and that's or trading, which is the law of multiple confirmation. And basically, it's where I'm waiting for a specific number of trading signals just to give me added confirmation that I'm moving in the right direction with the trade, because obviously through markets you get a lot of false signals, and you need to be aware that false signals are a problem. Hold on, I've just got a question here. Not seeing any charts. Well, I haven't put any charts up. Can you see the slide? Because that is what I'm talking about at the moment. But I will talk about charts in a bit. But just for now, okay, fine. Okay. Yeah. So just waiting for confirmation, really. Basically, because you've got so many different aspects, indicators that you're looking at through your trading, but you want to see as many as possible, I think, sort of confirming your ideas before you jump in, because as I said, false signals are rife in technical analysis, and you basically it's very unlikely that you're going to be able to buy at the bottom or sell at the top. So I would say waiting for confirmation signals is advisable when you're sort of trading, because if you don't, then I think you can find yourself jumping in too soon. Right, trading the same setup more than once. Now, this is an interesting one, because you basically you've done a successful trade, you've taken your profit, and you still think you've got that sort of nagging doubt in the back of your head: should I still be in that trade? Well, I would say that if you jump straight back in, then that is a bad situation. You're sort of not doing the required analysis that you need. You need to effectively treat it as though you're getting on a brand new trade. And I would say that if you don't do that, and you're sort of jumping in straight away without doing the required thought process, then I would say that is overtrading. Because you're effectively jumping into a brand new trade, and obviously it can go wrong. You could have had a retracement in that move, and you get stopped out. Doesn't necessarily mean it's the wrong trade. However, you need to sort of take that required level of analysis before you take your positions. Treat every trade as a unique position. Don't just think that just because you've just jumped in on euro-dollar long, you've made a profit previously in the last couple of hours, maybe I'll do it again. Well, it doesn't necessarily work that way. So just keep that in mind. Right. Leaving your trades running well over your time horizon. Now, this is another one. For example, if you're an intraday trader and you've got positions open over a few days, I would say that is probably running into well over your time horizon. There are, I suppose, pros and cons with this, and I suppose it does depend on what's happening in the market at that time. If the market has not moved, then you've probably entered the trade at the wrong time, and you should probably consider closing out the position, basically, because don't just sit in a trade just because the market's not moving. If the market isn't moving, then the chances are that the analysis that you've done has either not worked out or has been incorrect. So you need to just take a view that perhaps that is the wrong position, and close it out, because effectively then it might become a case of a 50-50 trade if you leave it open. So I would say leaving your trades open for well over your time horizon is again a sign of overtrading. There are always exceptions to the rule, and for example, you might be running a winner, and you might be actively managing your position, so ensuring your stop loss, or your profit trigger, I suppose you'd call it at that stage, is nice and close is a good idea, and use effective trade management. Now, we spoke about trade management in my last webinar, and the recording's still there on the website for you to run through that. But use effective trade management, because I suppose effectively you are still looking to run your winners. So if you are in a position and it's going the right way, just because it's gone over your time horizon doesn't necessarily mean you have to close it. The point I'm trying to make is, if you're sitting in a position that's not moving and you've moved over your time horizon, then I think you should be thinking about closing that one out and just looking elsewhere. Number 5, you've always got a position open. I suppose it's similar to leaving your trades open, really. I mean, if you're always in the market, the chances are that your trading strategy needs to be redefined or refined. There are often times that I think it will be best not to be in the market at all, for example, and having a feeling that you want, or perhaps even more dangerously need, to be in the market can certainly be a sign that you shouldn't be, I think. And certainly if your strategy isn't throwing up any ideas, don't stress about it. Don't think that you have to be trading in the market. If your trading strategy that you've put all this time and effort into thinking about is not throwing up trading ideas, then it's not throwing up any trading ideas, and you should be just waiting for a signal. Don't force the market, I think, basically is the key factor that I'm trying to look at. Being out of the market, actually, or being market neutral, I suppose, in that situation, can actually be a form of trading, because sometimes market conditions are not going to be favorable for trading. So just bear that in mind. And number 6, trading simply because you've got the margin availability. Again, this is also part of trading without going through the required thought process and the required trading strategy. It's pretty lazy and suggests you're not really looking at the big picture in your trading. And also, I think it can leave you overexposed to market volatility. Certainly if you're not putting in the required thought process and you're trading effectively, therefore comes a bit of a 50-50 bet, and you're in the market and you can be exposed to big volatility. I'm going to say something a bit controversial as well, because they are out there, but I think it also this sort of makes me think of sort of an unscrupulous advisory broker that basically sees that you've got margin on account. He's looking to get a bit of commission, and he sort of nudges you into a bit of trading. But I would say that that is a very dangerous way of trading, and basically it's not the required way that you should be trading. You should be sticking to your trading strategy. Right, emotion trading. I'm sort of going to brush over this a little bit, because we talked a lot about emotion trading last time out. But overtrading does obviously have links with emotion trading, looking at anger, revenge. Basically, these are feelings that can lead you to trading in a rash manner. Again, being resentful is another aspect of that, feeling that you need to get even with the market. So all these things can drive overtrading. And I've got here at the bottom, remember, a hot-headed trader will rarely make the right decision, and that is the case. So just be very careful about sort of being overcome with trading emotions, basically trading on emotion. Right, overleverage. Now, I would class overleverage in the same sort of as trading in the same manner that engages with too much risk for your acknowledged tolerance for risk. So basically, you're taking on trades that are too big for you, really, and you've basically got in your trading strategy that you've thrashed out with your broker, hopefully, you've come to a decision onto how much risk you want to be taking on in your positions, and being over leveraged would be that you've sort of gone beyond that amount of risk tolerance that you can handle. So trading, I would say that trading shouldn't necessarily be something that sends the pulse racing. You should be sort of fairly comfortable in the positions that you're taking, and if it is a case that you're getting you're sort of feeling your pulse racing and your heart pumping quite a lot when you're trading, then I would say that the chances are that you're probably over leveraged in your positions, because you might be seeing wild swings in your trading account that doesn't necessarily help with your sleep pattern anyway. So maybe in that scenario, you'd probably be having a rethink of your trading strategy. I would say perhaps if you are finding that is the case, then I'd start with a very low risk per trade, and then perhaps just build it up until a point at which you're comfortable with the level of risk that you're taking on each of your positions. Basically, you don't want to be running a risk per trade that means that you're sort of at risk of ruining your account in sort of a handful of positions, because that's not what you're looking for. You're looking for quite a long period of trading, and you want to be building up your trading account nice and steadily. You don't want to be sort of flying around on your trading account, and then that would sort of drive you certainly increase your stress levels anyway. So that is the case. Bill, I will be getting to, interesting that you've asked me about a 10 grand account, because I will be talking about that in a very short space of time. So just be ready. Okay. So where am I? So yeah, basically when you're trading and you're going to make mistakes, and I suppose with that your success rate may not necessarily be much better than maybe half the amount of time. But if these mistakes come in a run of losses, then if you're trading at high risk over leveraged positions, then you can have a massive impact on your trading account and also your psychology as well. So what I would say is one of the key signals to whether you're over leveraged or not is probably looking at the attitude that you have to your mistakes. Everyone makes mistakes when they're trading, and what you need to do is you need to learn from your mistakes and actually use them as a positive. However, I would say that if you're over leveraged, you've probably got a bit of a different mindset to that. You start to get really stressed about all these mistakes that you're making, and you then start to sort of lose rationality, and you start not to use them in a productive way. I suppose, sort of going, you can sort of enter into the blame game. I suppose you blame yourself, sort of feel stupid, and also the market as well. And you sort of takes me back to what I spoke about in my last webinar again, as to sort of the feeling of revenge and emotion trading. So basically what happens is when you're over leveraged, or you find yourself over leveraged, is you see that you're sort of feel massive regret, and you sort of rue your mistakes and everything. So just all the unconstructive negative emotions basically that drive your trading. Right. Examples of over leverage. Now, I've got a couple here. First of all, the being over leveraged through your trade size. Now, this is where Bill might get a bit more interested. Being over leveraged through trade size. Over leverage can stem from, I suppose, simply not understanding the platform and sort of setting the incorrect lot size. But I'm going to presume from the fact that we're talking about this webinar now, is that you have a basic grasp of the platform, and you know sort of your way around the basic lot sizes. But if you don't, then just have a look at the ebooks on our website. But the main form of over leverage, I would imagine, or I would say, is sort of putting a trade size that's too big for your sort of acknowledged level of risk. Now, I went through calculating trade sizes in my last webinar, and there is a specific process that sort of stems from the amount that you got on your account and the amount that you're looking to risk on one position, and that is called your risk per trade. Now, for example, on a $10,000 account, and you're sort of looking say for example looking to risk maybe 1% of your account, that's $100 on every position. That's a risk per trade of $100. Now the way that you look at working out your trade size is through the calculation of a stop loss. So basically, as I said, you're looking at trading $100 and you've got a 50 pip stop loss on trading euro dollar. Then basically it's sort of equates to doing a calculation of 100 divided by 50, which is $2 per pip. And $2 per pip is basically you have a trade size of 2 mini lots, or 0.2 lots of trade size, and that would be driving a $2 per pip trade size. If in this situation that your stop loss got triggered, you'd lose $100. But because that's within your accepted trading strategy, then, oh, sorry, wrong one. If you find that that's within your accepted trading strategy, then that's all right. But I would say that you need to then sort of be careful of playing around with the lot size, because say, for example, you thought it was a good idea to trade one lot, which was $10 per pip. In this situation, you've then got two different ways you can play it. You can either keep the same risk per trade, which is $100, but therefore, if you're trading one lot size on $100 worth of risk per trade, that means you can only allow yourself 10 pips of a stop loss. So effectively divided by 100 by $10. Now, you're not necessarily overtrading in this, but I would say that needs to be a massively high conviction trade to justify only 10 pips of stop loss, because obviously, as we all know, or anyone who's traded forex markets, euro dollar, whatever, 10 pips can happen in probably a matter of seconds potentially. So you need to be massively high, have a high conviction in your trading to trade a stop loss of 10 pips. So if you're trading one lot of $10 per pip, and you sort of want to keep your same pip, your same stop loss, then you're going to be risking $500 of your account, which is on a 10 grand account, 5% of your account. Now that is a much, much, much higher risk per trade than you had before, obviously 5 times higher, and potentially therefore you are over leveraged, and you need to be you need to be aware of that. So if you're going to trade in higher lot size, you need to cut down the number of stops you've got to keep the same risk per trade, because you're going to be in danger of you're going to be in danger of being over leveraged. And effectively, you're in that situation. If you keep that 50 pip stop loss on trading one lot of size, then your trade size becomes too big to cope with the stop loss. So basically what I'm saying is, if you increase your lot size, you need to proportionally reduce the size of your stop loss to keep the same risk per trade. It's very important. Right. Okay. Sorry, I've just got a question here, so hold on. Okay, Bill. Well, it's difficult to say that, because obviously it depends on what the pivots are in terms of how you're trading. Okay, so Bill's asked the question: adding moving stops pivot by pivot in a 4-hour setup. What I do is with my swing trades. Is what I do with my swing trades. Are you in agreement with the strategy? It entirely depends on. It entirely depends on where the levels are, because, as I said, the number of pips of stop loss you have can drive. It's all part of the equation of working out your risk per trade. So you've either got to move your risk per trade and reduce your stop loss, or have a wider stop and have a less sort of lot size. So you've got two different options. It probably doesn't massively answer your question, but for the sake of what I'm talking about here, that is sort of what we're looking for. So, okay, so I'm going to get back to it now. Over leverage through over exposure, the second point. this is when you're overexposed to the market. For example, you've got a sell signal set up on euro dollar, but then you get another sell signal set up on sterling dollar. Effectively, you want to trade them both, so you can. I mean, it's within the realms of your trading strategy because you've got two different signals on that. However, I would say in that scenario, you are taking, if you take both trades on board and go short euro dollar, short sterling dollar, then you are effectively going long dollar on two different trading setups. So effectively, you're taking on the same trade, which is a long dollar trade, but with double the risk. Because if you keep your same risk per trade, say for example, your normal risk per trade is 1% of your account, and you do 1% on euro dollar, 1% on sterling dollar, on both on the short side, you're taking a 2% effective. I mean, it's not exactly, but bear with me. Effectively, you're taking a 2% risk per trade on a long dollar trade. So that is something also you need to be aware of. Because effectively you're, as I said, you're effectively trading the same dollar trade, both sides. So in that scenario, say for example, you're short euro dollar, short sterling dollar, and you get a disappointing announcement of US data, and the dollar subsequently gets sold off, and subsequently euro dollar rises, sterling dollar rises, you're short on both of them. Both trades can be stopped out, depending on obviously on your stop losses, but both trades are basically going to run the same way. So you're running two trades at the same time, and effectively you're running double the risk, in my opinion. So what I would say in this scenario is that if you were, as I said, there are two different ways of playing it. You can either open both positions but reduce the risk per trade. So effectively you do half a percent of risk per trade on your euro dollar, 0.5% on your sterling dollar, to effectively therefore get your 1% on your long dollar trade. Or what the better or the more experienced traders would do is to basically pick the best idea of the two of them, the one that gives you the most and best highest conviction, and trade that. Don't trade both of them, because as I said, what you're looking to do is you're looking to trade the best setups, best trading setups in your trading, and that is how you do that in that situation. You'd pick the best one out of short euro dollar, short sterling dollar, and just trade one of them. Right, the impact of overleverage and overtrading and overleverage. Pretty simple, really. It's sort of a fact of making you stressed, really. Effectively, I suppose you could summarize it as leaves you feeling as though you're juggling too many balls in the air, and a sense of confusion as well. You don't feel as though you've got a handle on your trading because you feel that you've got too many instruments going on at the same time. You can leave yourself overexposed to market volatility, and effectively you feel yourself overwhelmed and out of your comfort zone. And got a key point here in the yellow box. If your trading is properly thought out and if your preparation is done, you should not find yourself overtrading or over leveraged. Right, what can you do to prevent overtrading and overleverage? Right, well, I've got 5 points here. Fairly sort of reasonably basic, but I think all things that you probably should be incorporating into your trading anyway. Point number one, understand the key signs to look for. Basically, just the things that I've talked about, really. So having too many open trades, running trades over your time horizon, not understanding the needs to adjust your stop losses when you've increased your trade size. So you've got that sort of seesaw effect of lot size versus stop loss size. Number two, plan everything. Now, I mean, I would say this anyway, but plan everything. Plan your trading day. Look at the timing of economic announcements, different key factors to look out for during the trading day. I mean, this trading at the moment is a key example of that. You need to understand what's going to be happening that day. Is Greece going to be a big factor that day? Is something going to be announced potentially that day that could affect the market? You've got non-farm payrolls next week. You've got all the PMI data. Loads of different aspects that can affect your trading. So if you're keeping positions open or running positions or thinking about opening positions, you need to think about what's exactly is going on. So yeah, it's all sort of impacts on the timing of your trades effectively. I suppose if you sort of introduce these small aspects into your trading, and it's going to help to sort of prevent the temptation to sort of for you to fly into trades basically. So plan your trades and make sure they conform to your strategy. I'd say keep a record of all your trades. When did you enter trade? Why did you enter it? What went wrong? What went right? What were the market conditions when you opened it? What were the market conditions that drove that drove your position? All these different aspects can let you sort of improve your trading knowledge, but also help to sort of prevent overtrading and overleverage. So basically, you're looking for a pattern in your trading style and seeing what works for you. Learning discipline in your trading. You want to be consistent. I would say learn self-control. Effectively, you're trying not to shoot from the hip. That sort of brings back to emotion trading once again. And effectively, you're looking to just get a handle on these emotions that could potentially send you off piste effectively, which is not what you're looking for. And above all, you're looking to stick to your trading strategy. If you can stick to your strategy, which is a well thought out strategy, then, well, I mean, effectively, you've put a lot of thought process into your trading strategy. So if you can sort of stick to that, then I would say that you're going to be able to control the emotions that drive over trading. You're not going to find yourself engaging in the same trades across different instruments and therefore unwittingly becoming over leveraged. And I've got this key tip at the bottom. Ask yourself one question: why am I opening this trade? If you ask yourself that question, take a step back, ask yourself that question, and give it some proper thought, then you are halfway sort of towards preventing overtrading and becoming over leveraged. Effectively, if it conforms to your trading strategy, you should be able to avoid overtrading and being over leveraged. Right, that sort of takes me to the next part of the webinar, which is looking at the markets. Whee. Right. Okay, going to start off with euro dollar. Zoom in a little bit here. Right, I hope everyone can see that okay. Right, euro dollar has had a bit of a drop away today, isn't it? What we've seen is quite a sharp move actually away from euro dollar, and you've sort of broken this uptrend that we've been in on euro dollar, haven't you? Big fall away, and what we've seen is momentum indicators starting to fall away. They had been fairly neutral. RSI had been sort of struggling to push above 60. I mean, I talked about that in my webinar. My trading chart analysis every day. But euro dollar was really struggling at 60 on the RSI, and then it's now just plummeted today, down 160 ticks now. No significant sort of economic data that's driven that. I mean, if anything, the flash PMIs were pretty strong. Now, what I've read is that there's an element of carry trades going on at the moment using euros to buy other assets. So that is helping to drive euro dollar low, apparently. And you're also seeing treasury yields pushing higher as well, which is again driving a stronger dollar trade. So a couple of aspects of this that are driving euro lower. And within this, you've had this breakdown of that big uptrend, and we're now testing all these key levels. Now I've got in here the Fibonacci's. Anyone who's sort of looked through my technical webinars on the website will know that I like Fibonacci, and you've got the Fibonacci retracements of this big bull run from that bottom or from that key low that was 108.25, not the bottom, but a key low. You've had that big bull run, and that's retraced, and interestingly enough, it's coming back towards the 50% retracement now. You've actually broken below 112 figure. Now, I see 112 figure as, or certainly was, a big support area. And the fact that you broke decisively below there today, I think is not good. You've also actually breached 111.50, which was a key low in June. So you're now beginning to get all these corrective signs. And looking at these hourly momentum indicators as well, you'd say that euro is certainly in reverse, bit overstretched, so you might get a bit of a rebound, and that's exactly what we're seeing actually on that RSI, starting to see a bit of a rebound. So you're now going to start to think about what to do with the euro. I would say that it is interesting because, oh wow, here we go again, actually 61.8. Let's talk about that. Oh no. Oh, don't freeze. Anyway, right, here we go. Right, 61.8 is at 110.50 area. 110.50 area is a massive pivot level on euro dollar. So that is your key near-term support. If you saw euro dollar starting to trade below 110.50, I think you're going to be coming back towards a full retracement of that, not only because it's a key pivot level, but also because of this 61.8% fib level. If you breach the 61.8% fib level, theoretically, you're going to have a full retracement back to that low at 108.18. But what it's doing at the moment is it's bounced, actually. So I would say that it's still in this sort of near-term sort of trading band, effectively. It has broken that uptrend, but I think it's it hasn't broken below 110.50 yet, which I think is the key level. So the fact is that I'm still looking at this being a trading a bit of a range between 110.50, 114.60, well 65, which was that key reaction high on the 15th of May. I think it's fairly range bound. I think it's just a continuation of what we've seen throughout June, which is not really a great deal of sort of direction. Yeah, you've had this uptrend, but it's fairly shallow. And also now you've broken it anyway. So I think you're sort of going to continue to trade euro sideways. You'll get volatility because euro has been very volatile throughout June. And obviously the continued news around Greece is going to add to volatility as well. So euro is certainly under pressure at the moment. Right, cable. Don't forget, guys, if you want me to look at anything, I mean, I'm going to go through the Forex majors, but if you want me to look at anything else, give me a shout. Right, cable. I think this is really interesting, actually, cable, because we've had look at these strong runs you had. In April, you then get a retracement. In May, you then get a big retracement. And you've had this strong run again in June, and I think we're now under a retracement scenario. So what I'll show you here is this big uptrend that's broken, similar sort of uptrend as to the euro. Not only that, if I zoom in here, you've sort of arguably completed some sort of top pattern. It's not a great looking top pattern, but it is a top pattern nonetheless, under 58 figure. Came back and rallied towards that neckline, broke down again like that. That suggests to me that you are in a near-term corrective phase. Now that the high-low sort of measurement of this. High-low measurement of this, yeah, Graham, I'm going to look at dollar yen in a sec, so don't worry. A high-low measurement of this cable, this top, gives you around about 157, just below 157. So you're sort of trading back towards this initial support, but then I think it'll be interesting to see what happens. Now let me just do a fib retracement. It's not going to be accurate because annoyingly this doesn't snap to point unless I get really zooming in retracements. So let's do a fib retracement of that. So 38.2 is 56.50 area. So I think, I mean, it's interesting that you've got a bit of a support around there anyway. Again, a bit of support around 50%. So I think the chances are you're probably going to retrace now back towards 38.2 on this sterling dollar chart. I think it is in correction mode. You've seen the momentum indicators, MACD lines, neutral, continually coming back towards neutral. 155 figure bill. Yeah, 155 figure is around about 50% retracement, and it's a big level of support as well. So yes, I do agree it's possible. RSI now falling below 35. Let me just get my crosshair on that. Look at this. Throughout that bull trend, RSI never got below 35. It's now pushing on, keeps going back towards 30. That suggests to me that we've seen the top or a top, and it's now in a correction mode. So yeah, just generally speaking, I think cable is looking fairly corrective. Right. Dollar yen. I will look at DAX in a sec, Gordon. So just let me just go through these a couple more. Yeah, I've got ages. So yeah, right. Dollar yen. Interesting because I've been talking about this coming back towards this big breakout. That big breakout 122 figure. Big breakout 122 figure. I've been sort of expecting it to retrace back towards there for a while. Now, 50% of this move, of that big bull run there that we saw in late May, early June, came at 22.35, and we've seen some bottoms here, 22.43 on basically a couple of occasions, 22.46 and again sort of 22.54. So basically that 50% fib level is important here. It's building as a support, and I think it's possible that we've seen the low now, because I've seen these momentum indicators starting to turn around. Stochastics turning up. That has been corrective for the last 2 weeks. It's now no longer corrective. It's starting to turn up. MACD lines nicely unwinding and starting to sort of bottom out again. RSI finding support around that 50 point. So I think this is a pretty strong chart still. What you'd be looking out for is a move above 24.43. So effectively, you've got sort of 200 pips on this chart of almost trading range, really. Sort of 200 pips between the lows. This is the hourly chart between the lows, 22.43, and that high, that reaction high that we had here. Again, 22.43 on the 17th. So you've got a couple of hundred pips of trading band, and at the moment, I think you're still playing out that trading band. We haven't sort of moved away from that yet. So maybe dips within that trading band, but back towards 38.2%. Look at the amount of times it sort of traded around 38.2% fib of that retracement level. Provided support and then provided resistance. So I'd say that's now your support. So I would be using that line there as your sort of basis, as sort of a buying opportunity to come in, because I think that dollar yen looks like it has now it's now in the process of building that new bottom, new low, higher low around that breakout level. So I quite like dollar yen. Okay, Gordon, let's do the DAX, but then I'm going to come back to the Aussie. GDAX I. German DAX gapped higher this morning. Interesting that, just zoom out here, we can see the fib levels of that big bull run that we've had since October. Big bull run, and the fib levels have been used, and used brilliantly well. Certainly in the last few weeks anyway. 23.6 capped the rally, and 38.2 capping three lows pretty much there. And we've now broken out above 23.6, so theoretically 23.6 is sort of now an element of support. So that is your support, and the fact that we've sort of broken up through that lower high at 1142, 452 sort of now changes the aspect of the DAX. It is arguably still fairly much of a range play. And the reason behind that being that it's sort of back in this RSI. If you started to see RSI above 60, I would say that yes, I think you're going to start to see probably a move back towards 11,920, which was that key reaction high from May. But at the moment, it's a little bit. Yes, it's strong today. What is it? 105 ticks up. So it is a strong move. I think it's going to move on the Greece story. I mean, it doesn't take a rocket scientist to sort of say that. But I think you'd be using a correction back to fill that gap. Hopefully fill that gap. You do get quite a lot of gaps on DAX that don't necessarily get filled. But I'd say that anything back towards that 11,400 area would be a sort of a decent buying opportunity if you got it. I don't think necessarily this Greek story is done and dusted quite yet, although I do think ultimately they're going to sort of fudge through a deal. And then subsequently, I think that's going to see DAX fly. I reckon DAX will be. I did a sort of projection for DAX for the year end for Reuters yesterday, and I'm sort of the opinion that I think DAX is going to test on the assumption that Greece gets sorted out. And I say sorted out, can kick down the road. On the assumption that happens, then I think DAX is going to test that key high again through the rest of the year, and then push out higher to new all-time highs next year. But I think it's going to sort of trade up towards that on that Greece news. Right. Oh, intraday. I haven't looked at that yet. Look, you not only that, you've got this little, arguably a little double bottom here on the DAX on that break of 11,452. So again, that double bottom sort of suggests that you are sort of moving back higher again. There's interesting. Look at this. Actually, I should have done this earlier. This is a pivot band, 11,620 to 11,710. This is a pivot band that I talked about through the end of May as a key level, key sort of pivot level. So while we were trading above that, it's bullish. While we're trading below it, it was bearish. Interesting that we're now hitting that pivot level, and intraday key 1 hour reversal. Well, does that now mean you're going to get a bit of a what is it? You've got another 15 minutes of this hour, so you've got still time for the bulls to react to that. But key 1 hour reversal could induce that correction. Look at these MACD lines starting to roll over, stochastic starting to roll over. This might give you that little correction. Look at that key 1 hour reversal there. That actually induced that latest sell-off. So these do work on DAX pretty well. So key 1 hour reversal or bearish engulfing, whatever you want to call it. Right, Aussie dollar. Why is that not changed? Oh, there we go. Right, Aussie dollar, interesting, because I have been talking about this pivot. This old support becomes new resistance around 78 figure. I've been talking about that for several days, and I did talk about this again today, because not only that, we've got the stochastics that have just rolled over. And when stochastics are in a sort of a bearish scenario, which they are really, because I say that you sort of have the Aussie mainly trading sideways throughout this year. It is sort of putting pressure on the lows more than the upside, I would say, but it's still, I'd say, in a more of a corrective phase. And the fact is that this rolling over the stochastics, which happens on a frequent basis, although it didn't work there, I give you that, it didn't work there. However, January, February, March, end of April, May, all of these induce a correction. So I would say that the fact that the stochastics have rolled over, crossed over and rolled over, I think you're probably now going to see a test of the lows. Again, also, here we go. When you're in a bear phase, the RSI struggles to get above 50, or maybe hits sort of 55 or something, but struggles. And once again, RSI has hit that 50 point or low 50s and rolled over. So interesting. Okay, hold on a sec. Okay, Grenville, I will look at the Dow in a sec. Just give me 1 minute. I'll just finish talking to the Aussie. Right, so Aussie, yeah, I think you're sort of looking for selling opportunities really on the Aussie. So basically, this is your hourly chart. I think you're going to be putting pressure back towards probably this old pivot. I mean, say 76.40 seems to be a sequence of lows through June. I'd say you're probably going to come back and test that now. So you're looking for your selling opportunities. You're seeing the RSI unwind. It's back towards 50 now. So maybe you're now sort of looking out for your next selling opportunity. And you've got a bit of a band of resistance, a bit of a pivot level around here, 77.40. So keep reaction low intraday, and provided the high today. So I'd say 77.40 looks a pretty decent level. So watch out for that. Right, let's go Dow Jones. Don't often look at Dow Jones. This is very exciting. Oh, whoops. Let's go there. .dji. Right. Forgive me because I haven't done techies on Dow Jones for ages. Hold on. It's not really going anywhere, is it? Last few months, it's not really gone anywhere. Basically a sideways trading range, isn't it? You're sort of pushing out towards the high of the range, I'll give you that. But look at the RSI. Never gets below 40. Oh, just below 40 there, 37 say. Also, in the last 3 months, never gets above 60. So basically, you're in a range trade. Looking at the moving averages, you're flat across the board. MACD lines are flat. Now, be careful with trading MACD lines in a sideways ranging market because they don't do a great deal, because you should be using MACD lines in a big, strong uptrend market or downtrend. So MACD lines are not great, but the RSI is basically telling you that you're stuck in a range trade, and there's no real suggestion yet you're going to break out. Big resistance up around that 18,400 level, 18,350, sorry. But you are still stuck in a range, and you're sort of trading towards the top of that range. It's possible that if Greece gets dusted, can kick further down the road, you're going to get further gains in the Dow. And if you do see an upside break of that range, you'd then to new highs, you'd then sort of measure that range, which is, let's see that, 17,600 to 18, so around about 700 ticks. So you'd say up towards 19,000. So you'd measure the width of that range and then project it higher. So yeah, that is the Dow, but it's not massively interesting. Although maybe you do find that it is interesting, Granville, but yeah, there is a reason why I don't look at it, obviously. Maybe subconsciously I knew that it was quite dull. Right, let's look at Kiwi. No, let's look at, yeah, okay, Kiwi, and then I'll do gold, because I know a lot of you do look at gold. Kiwi is in a perpetual state of selling pressure now. Ever since the Reserve Bank of New Zealand cut interest rates and said that they were going to do more, it's been, what is that? .nzd? That's wrong. NZD equals. Ever since the RBNZ did that, it's just been in perpetual decline. You had that was, I think that was the day that it happened, and then you just been selling off ever since. Basically incredibly negative across all fronts on this. You could argue that it's done a downside break of a range, sort of 71, 75, and sort of that old resistance, that old support became new resistance. So I suppose you'd then take that as what, 500 pips measured down, gives you what, 70, sort of 66.50 area, 66.75. Interesting that if I zoomed out, that is not a million miles away from the next key low on Kiwi, which is 65.50, I think it is, 65.60. But look at that move. It's just not stopping at the moment, and it's very weak. Even on the hourly, I mean, you've had a rebound. I would say look at this 89-hour moving average, the blue one. Seems to cap pretty much the rallies, and that comes in at 68, sort of 69 figure area. So you about 50 ticks away from where you are now, 50 pips away from where you are now. But yeah, so it's just unwinding that position oversold near term. I'd say look again. Wow, here we go. If anyone likes to use the RSI, this is a classic example of it. Look at that. Every time the RSI gets towards 60, never gets above that. Well, I say never, slightly above that in there. A little rally there on the 17th, but the hourly chart, that is a classic bear market scenario where the RSI fails at 60 and then goes back to oversold. That is classic bear market territory. So Kiwi dollar does not look great, and you're selling any rally. So you're currently 45. If it gets to sort of 50, 55, I'd start to think about your selling opportunities. Ideally, that would come again. Look at this. Actually, this is where the old support becomes new resistance. So that's going to be, yeah, if you got it 60, 68, sort of 80 odd, that would be ideal. So yeah, it looks pretty bad. Right, gold. Now, what you have seen in the last day or so is a massive reversal in massive reversal in safe haven positions. Safe haven positions which were looking pretty strong last week are now no longer strong. You've had a big correction back again. Look at that on gold. Really, just completely and utterly unwound that move back towards. Here we go again. Look, 75. I've said this a lot recently. 1175 on gold intraday is a brilliant level. Just seems to be every time it gets towards 1175, it sort of finds a bit of support. That, in a way, I suppose, is encouraging. This is the intraday hourly chart. And today's low, 1175.80, so not far off 1175, but every time you get towards 75 recently, it's sort of a key level. So that is your key support. You need to be watching out for that. You had a couple of hours worth here on the 15th where you sort of dropped below that level, but 1172.50 was that low. So if you're going to sort of get exact about it, maybe a closing basis on an hourly chart candle on below 1172.50, but 1175 on an intraday basis is a massive support on this gold chart. I think you're still ranging, although you could argue that the stochastics have crossed back over again, and it's under pressure, isn't it, to the downside? A couple of big strong bearish candles. So if it closes below 1175 today, then maybe that is a sign that you're sort of breaking down again. But it's been a really quick turnaround actually in sentiment on gold. This dollar chart has this dollar position is strong. Okay, one more, if I can do one more, is oil, WTI oil. Just, I hope I can pronounce your name right. Is it Ephraim? Hopefully. Otherwise, I apologize. Okay, here we go. WTI, West Texas Intermediate. CLC1 for anyone who likes their codes. Or not, because that's not the code. Capital C, capital L, C1. Right. Wow, interesting. We've actually seen a bit of movement. Basically, the oil price has been moving sideways for ages, sort of 6 weeks, 8 weeks. Never really sort of gone anywhere. You see quite a lot of volatility in oil at the moment, and it is fairly much a range-bound scenario. But, and I mean, on my daily chart analysis, I've been talking about oil sort of trading between these fib levels. Every time it gets towards the 50 level, it sort of rallies. Every time it gets towards that sort of 23.6%, it falls over. You've seen another rally actually, and it could now be pushing out towards the range highs because that is a pretty strong rally. And it could well be that is the case, but it is interesting, isn't it? Because that is unfortunately they're the wrong fib levels. But oh god, that's annoying. No, they're not. Well, they can be, but anyway, they're the fib levels for that chart there. But anyway, interesting that we've seen a sharp rally today that's come. I don't know on what because I haven't seen, but certainly is a strong move. So you need to start thinking about potential selling opportunities because it is still a range play. It does tend to not have any direction at all, so it tends to keep mean reverting. So I would say that it is interesting that we've seen this move today. Maybe play the RSI up towards 70 if you see a sell signal. Then maybe use that as a shorting opportunity. But it certainly looks as though once again we've had another rally towards those range highs, and I would be using sort of this move as probably a chance to sell because I don't think oil is going to be breaking out anytime soon, certainly not on these charts anyway. So that is what we're doing there. So right, fine. Well, thank you very much. Let me just show you our website. Anyone who's not signed up for the research, you can click there and you get all these research announcements that I write. I do a daily morning report, weekly strategy report and on a Monday, and also during the day I'll do a trading blog as well. You can follow me at HandTechRich, which is my Twitter handle, and also you can sign up, do a lot of posting on Forex Traders Talk on our which is a LinkedIn group that we're involved in. So yes, have a go there. But with that, if my doesn't work, why is it not working? Maybe it is working. There you go. Right. So you've got daily market research, handtechfx.com, blah, blah, blah. So that's that, and then disclaimer. So thank you very much for listening to me today. I hope you found it interesting and informative. And we're going to be doing another one in a couple of weeks' time. And this is my I think it's on the 9th of July. And it's on my tips, basically my key tips I've picked up from trading. And we've already got quite a few people signed up for that, so make sure you get involved, and I will speak to you next time. But in the meantime, I wish you good luck in all your trading, and you can email us, and I'll get back to you. And thanks a lot for all your comments and feedback. It's very useful that you get involved. So thanks, guys, and I will speak to you next time.